Hi, folks. Rick Waddell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you with a brief market update, kind of let you know what's going on. We are right here at the beginning of June. And the S&P 500 is right around 4120 as I'm speaking. We got a little bit of a rally late last week and early into this week, which means that for the month of May, despite all of the daily volatility and bouncing around and weeping and gnashing of teeth, we actually wound up unchanged for the month, essentially, for most major market indices. Which is kind of a good reminder during these times of excessive volatility within the marketplace that it's very difficult to try and market time these things. It's very difficult to try and trade in, trade out. Make sure that you call the bottom or call the top. Anyone who looks at the month looks at this year on a week by week basis would see that during the month of May, we sort of top ticked right around 4,100, maybe a little north of it on the S&P 500, and bottom ticked around 3,900 on the S&P. So, fully a sort of 5-6% intraday move. However, if you flip that around and think about it on a month by month basis, you would see that actually you came through the month of May without any changes to the marketplace. So once again, a reminder that, there's a lot of volatility out there, and so you have to be careful with trying to day trade it. In terms of market developments that are out there, today it marks the day that the Fed will start to shrink their balance sheet. So this has been widely announced and communicated. It is largely expected. In the market, we are calling it QT2. It is the second time in about 5 years that we have tried to shrink the size of the Fed's balance sheet. And the playbook is largely the same. The Fed will stop reinvesting maturing securities that they hold on their balance sheet to the tune of about $30 billion per month on the Treasury side and about $17.5 billion a month on the mortgage-backed securities side. In total, that will not be quite as, those are the caps in total, given the way that interest rates have moved and the fact that mortgage-backed securities tend to not be refinanced that frequently as interest rates move higher. The $17.5 billion on the mortgage-backed securities side is unlikely to actually be a cap. So anyway, we're looking at call it $40 billion a month in principal maturating of securities that will likely be refinanced into private hands. It's widely expected the market, anticipates this. There's been what I would say some writing around, oh my goodness, how in the world will the debt markets cope with this additional supply? And I think the expectation is from individuals who watch the debt markets quite closely is they'll handle it quite well. It's been well telegraphed. Yields have already sort of moved on these securities. And the Treasury will work in terms of thinking about how it refinances those maturing securities to make sure that we kind of minimize the impact on the curve. Neither the Treasury nor the Fed want to destabilize debt markets with anything that they do. So it's worth noting because it's a little bit of a historical event in financial markets, but based on today's market reaction and sort of anticipated in the future, a minor event as far as prices go. Last but not least, what's going on in the marketplace today? Saudi Arabia did announce that it would increase its own oil production to the extent that Russia's production started to decrease. What I think is interesting here, OPEC has come out and basically said, look, we've done all we can do to stabilize global oil prices. We're just going to have to live with $100 oil. And there's a lot of reading between the lines here. OPEC has wanted $100 oil for a very long time. All of these countries export a lot of oil. And so this notion that any of the OPEC countries would really prefer to see lower oil prices is a little bit silly. I do think it's interesting because it demonstrates that given enough time within commodities markets, profit incentives start to take over. And so it wouldn't surprise me as we start to see more supply come online, whether that's in the United States or through OPEC or wherever else, to sort of absorb a little bit of the slack that's been created in global oil markets. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great week, and I look forward to talking to you again soon.
Thank you for tuning in. And if you're enjoying this content, please subscribe to our YouTube channel and click the bell to be notified when we post more.